most of us feel that we are between either seeing a growth of over 10% or we are seeing it range bound. We have something like 42% of us saying that we expect the Nifty to grow by over 10%. We have 47% saying that we expect it to be range bound, that is either falling up to 10% or growing up to 10%. So, and of course falling, we don't have too many bears in this room. We have only about 11% of us feeling that it can fall by more than 10%. So it's interesting, and so I think the current market environment has maybe frustrated us as well, okay, and has been reasonably range bound, and whenever it goes up then it also comes down, okay. So that is something that we've been seeing. Of course, in some of the areas and segments we've also seen a sharp correction, like in the small caps, right? So thank you for polling. Yeah, so coming back to the point of saying, with this volatility, okay, what is it that an investor needs to keep in mind? Because typically, we end up making a few mistakes, okay, due to volatility. You may also see, let's say, two emotions come in, typically with markets. And my view is, if you are able to overcome the emotions, then you actually make money on markets. So one is fear and the other is greed. So when markets are volatile or falling down, then fear kicks in, and that results in us maybe selling quality assets after a fall. Okay, it's pretty surprising, because normally you'll want to buy low, sell high, but we may not sell when it is high, but we want to exit when it is low. That is because of this emotion of fear, right? And the second is about and once you take that money out, then you are ensuring the permanent loss of capital, right? Because you're not allowing it for a rebound, and which sort of is a cycle, and one ends up chasing up the winners. In recent times, for example, AI is trending, and many of us who have ESOPs, etc., okay, have the scripts, and we don't feel like selling, right? And from what I've seen, anybody who's invested in US markets also is into these stocks, right? So we are all chasing the winners, and the issue that happens at such times is, if you miss a turning point, then the value destruction also is large. So this is my last point, which I mentioned, that it's about how we are able to maintain a discipline, how we are able to maintain an asset allocation, and ride the wave, but also take some money out when the going is good. And the left chart actually brings that out. You can see that, interestingly, small caps were the ones that fell much more, right? And one would not have felt like investing in small caps, but from the low, you can see that the recovery has been very sharp, right? So that is something that one sort of keeps in mind, that even while things are down, if you are in the right places, if you are disciplined in your investing, then there's nothing much to worry. Okay, of course, it may still require to review your portfolio and take necessary actions. That brings me back to the point of we spoke of oil and we spoke of wars. We'll capture both of these with data. And if you see, we've looked at all the major wars, and what is interesting is, the correction. There's definitely a correction during the war. Okay, but if you look at even 2-3 months from there, you will find that the returns are very, very good. So actually, war creates a short-term impact during the period of the war, but then after that, once it bottoms out, actually, it leads to a new phase of economic growth. Why is that? Because there's a lot of rebuilding that has to happen in that period, and actually that sort of kicks in some bit of economic growth. Sometimes you find governments also coming back and providing certain incentivizations, lowering interest rates, and various other measures to cool things down, and and that's sort of allows you to make some additional return. So summary of the slide is that wars have a short-term impact, but in the long term, actually it leads to a positive impact. The other is coming back on the impact of oil. And here we've captured all the spikes in oil of over 40% in 3 months. Okay, so that is, and if you look at this chart, you have a whole lot of them, and some of it, during the OPEC embargo was almost like a 300% rise in oil, right? So of course in COVID also is showing a very high number, but that was also because oil fell very sharply. But otherwise you'll find that from a reasonable price it's gone up much more. And if you see, the current price rise is not the highest, okay, and there are many more in that range of 70 to say about 85% in terms of oil spikes. Okay, and again, what is interesting is, if you look at, we've looked at both gold and we've looked at the Sensex. Okay, interestingly, post 12 and say 24 months, you will find that actually the index does very well. So that's the second point, because most of people say, oh, what's the impact of oil? India is very dependent on oil, and etc., etc. But actually, data shows us otherwise, that it is not as correlated as we think. Again, during the period of the spike, you may find that even there, unlike wars, there is not necessarily been a fall in the Sensex in those periods of time. Okay, but definitely on a longer term, oil itself has no major impact. If at some point of time, there is a bit of a negative, like what you're saying in the Sensex in say 24 months, right? After the OPEC cuts, it's more because of other reasons. Because if you remember, at that time we had subsequently, the dot-com bust that you saw. So it was nothing to do with oil, right? So the point one is making is that the correlation to oil spikes is not too much, and oil doesn't have a long-term, a spike in oil price doesn't have a long-term impact on the markets. So which is good news for us. So for a lot of us who are, let's say, concerned about it, this is something that we sort of keep in mind. The other is about, I thought let's capture also, yes, things have been buzzing globally, which is why I thought we will do a global comparison. And what is very interesting in this is India is right at the bottom of the pack, right? So in this particular chart, we are the third last. Okay, so if you see, that has been the case, and from a period, let's say about 18 to 24 months back, where we were at the top, probably similar second or third type of ranking there, we've come to the bottom of the pack. Okay, so now we can look at it in two ways. We can say, okay, India is not a place to be, okay, is what may come to mind. But I think what has happened is, if you look at the P ratios, etc., have sort of cooled down, which is basically telling us about market valuations, and that sort of makes it interesting. The second is, even if you look at the GDP growth, etc., we still are, possibly one of the fastest growing GDP country globally. Okay, and so it's nothing to do about whether the country is growing, whether GDP is growing or not. It is sometimes to do with valuations. It's sometimes to do with something which is down quite a bit. Also, some of the countries which are down then come up, right? So that is something that has one keeps in mind. And yes, you can see that Taiwan and many of the other developing countries and emerging markets also are doing well. So not only is we'll look at some of the themes as we go forward. What are the themes that are doing well? But definitely India is at the bottom. But what do we say from here? Is it a point to avoid, or is it should we just go and invest globally and not invest in India? Okay, or not? Okay, or otherwise. So if we look at it from a valuation perspective, India has come back to sort of an undervalued sort of number. And sometime back, there were a lot of concerns from FII saying that India is very highly valued. Okay, now the point to keep in mind is some of the other countries were, if you see right now, in Brazil, China, etc., Italy are at 10 to 13 times PE. right? So which is far, far lower valued than sort of India. But you will find that the differential has significantly come down. In fact, we are much cheaper now than the S&P or the Nasdaq. Okay, because many times you would find it the other way, that Indian markets, because of its growth, typically commands a premium, and FIs were concerned about it. But right now that has changed. Okay, yes. There were markets like Taiwan, etc., which were in the undervalued zone, and they have come up very sharply. Okay, thanks to a few of their, their chip manufacturing, companies that have done very, very well, comprising a good part of their index. So that is something which has you found that some of the emerging markets have done well in the past period of time, and they have sort of come up in terms of valuations as well. But India still, I think is at a reasonable place. And so looking at market returns of various categories, now we spoke of, countries. Now we've added also a few, like, hydrogen, for example, right? If stocks which are hydrogen, in the sector, actually the ETF has given 102% return. Okay. Similarly, we've spoken of Korea and Taiwan as well. So you will find that Korea has done extremely well, right? So oil as well, semiconductors. So there has been a number of places which has seen good return and things have been trending, right? So one wanted to give you this perspective that yes, there are pockets outside there that, in fact, that sort of got us to also think about, should we look at, let's say, sort of managing a fund which is a global ETF portfolio, and that is something that we sort of come out, and possibly in my next webinar I'll spend some time on that. But definitely, global is interesting, but one has to be very, very selective, because you cannot just go across the board and invest. The very specific places where we are seeing returns out there. Now coming back to do we see any catalysts? What are the outlook, etc. For markets as we go forward? Okay, I'll step back first and say that actually in volatility you are able to identify opportunities. Okay, and that is something for us to actually take advantage of. And so if we are able to take advantage of this volatility, then that will sort of do well for us. Okay, so now do we think volatility is over? We believe that for maybe the next 2-3 months we may still see some bit of volatility left in Indian markets. So we're not just jumping overboard and saying that yes, things are hunky-dory. We still see some bit of volatility over the next 2-3 months. And once that is over, we believe that we will see a very strong, say, market move. Okay, and so if you see in March 26, okay, you would have found that the Nifty actually fell below 20. Okay, so a very good and decent correction that we saw. And since then, of course, there's been a recovery, and Nifty is at 21. In fact, the recovery is even more stark if one looks at the small caps, right? So and keep in mind that small cap at 23, 24 was at a discount to long-term averages. Okay, so that is the and this is again I'm stressing on the point that in volatility, in corrections, actually there is an opportunity, and we had an opportunity in small caps and probably continue to have one. Now, what are the drivers and what are the catalysts for growth that we think can come up? One is, of course, there were trade agreements with the US and EU and stuff like that. So those trade agreements, I think, will sort of have long-term benefits for India. We are seeing reasonable policy stability. Okay, the government continues to invest. It have its capex driving growth. Okay, and there is an infrastructure-led economic expansion that one is seeing. So now that is definitely there. So the government policy is supporting. RBI also is supporting with liquidity support, etc. And in the period where liquidity was tight, RBI did come significantly and support there. So which is again good that government is proactive to try and support the industry and which will also support markets. Earnings and valuations is definitely become reasonable, so that is going to be a good driver for the markets as we go forward. And we have government capex, which is also continuing to be strong, right? So that brings me back to okay, so we think India is likely to do well, maybe volatile in the short term, but medium to long term likely to do very well. Okay, and small caps have sort of taken a recovery and recovered from their volatile periods and likely to continue to do well. But the point that I wanted to make is that it is not widespread again. Okay, like when I spoke about countries, again sectors, etc., has to be one needs to be a little cautious on. And what has been interesting is some of the portfolios, like some of the sectors like capital markets, which we have been bullish on. Of course, in the volatility, it resulted in us taking a hit on the sectors, but we had expected to come up. And if you see, one of the strongest recoveries that you're seeing actually is coming from capital markets and reality. Of course, reality, is a very risky sector. So from that point, we are preferring sectors like capital markets, and that has sort of done well. So defense is the other place that has continued to do well. You will find that the PSUs is a mixed bag. Railways, which had corrected very sharply, has recovered well, but you will find that PSU banks, which did better earlier, actually are coming right at the bottom. Okay, so the point I'm making is, sectors are rotating. Okay, banks are not doing as well. Okay, you're finding within the financial services, capital markets is doing well, but banks are not, right? So that's something that for you to keep in mind, that one needs to be a little dynamic in terms of and looking for sectors that can do better for the future. The big positive that we see is actually earnings growth coming back, and earnings growth for small caps was poor, and that's why we have this chart only of small caps. You will find that in second quarter of FY25, actually we saw a negative PAT growth. Okay, so that was something which was very surprising, and that sort of also resulted in the correction that we saw. But the good part is, in second quarter of FY26 and the third quarter, this earnings growth has come back reasonably strongly. And in the period before, one found that mid-cap stocks, their earnings growth or the profit after tax growth was the highest among categories. But now, small caps in the last 2 quarters have sort of come back and also now taken the lead, because typically you will find that large caps will have in the long term the smallest earnings growth, because they are large blue chip companies. They grow slower, and followed by mid caps and then small caps. Okay, so small caps typically grow the fastest. Okay, so that is the typical trend, and we are back to that trend. Okay, now if you see that what is it for the current quarter, and it's ongoing, so it is preliminary, right? So for whatever companies that have come out and announced their results, what's again heartening is that even in this the last quarter where the results were announced, which is quarter ending March of 26, okay, one finds that small caps again are doing the best in terms of growth, followed by mid caps, and then you have followed by sort of large caps have been a little bit muted in terms of their growths and profits. Okay, so that is something for one to sort of keep in mind. And yes, the point one would like to make is that what's the best way to predict growth in your stock price, right? So we just have a chart of Nifty 500 earnings growth versus, let's say, the Nifty 500 index, right? So you will find that the Nifty 500 index and the EPS growth almost converge. Okay, in fact, that's what we do on our PMS. We basically say that let us control the controllables for us. We are actually focusing on earnings growth. How do we ensure that the companies that we invest into have the best earnings growth? And if that happens, then we think that the stock price also will follow, right? So So that's the best correlation between, you will find that the Nifty and the earnings growth. Interestingly, for this period of time, you will find that the earnings growth has been faster than the price. Okay, and this also has to do probably with the Indian markets not doing as well, because if you see, typically the gap is not as wide as it is right now, and we think that there will be periods when price action comes in and price does well, and it will probably even go ahead of the earnings growth. Okay, so that's something which is there. Now again, if you have to crystal ball gaze, we go back to the past and see, okay, and again we are looking at small caps because we're looking at the contrarian side, right? What has done badly, right? How is it likely to do, and what is the thing? Because if that happens, then we have two perspectives. One is, okay, how do we participate in that small cap rally early enough? How do we enter in? And the second is, yes, if that happens in small cap, we'll probably see a broader, market moving. The Nifty, etc., would sort of not do too badly. So what is interesting is, Q4 is when you find, the worst performance, and this is for a period of over 2 decades is when we have looked at it. So basically, we looked at it from December of 2003. Okay, if we looked at every year from December 2003, okay, every month, okay, every Jan, what it has been, Feb, March, etc. So we'll basically see that the last quarter is when you see a negative, and then it starts recovering from Q1. Interestingly, Q1, the recovery is very solid, right? So that is something which is there, and a lot of it happens in April. That is, this April also we've seen a very strong movement, right? So yeah, so from here, but these are sequential, returns there. So in a single month, right, 2% means 24, percent a year, right? So that's something that one keeps in mind. But of course, you have some at 1, some at 0, right, some at minus. So that sort of, averages out and gives you, what is the overall return that you sort of look at. But the point I'm making is that cycle-wise, in terms of time, in terms of month, and in terms of quarter, the small caps have followed it. Yes, typically if you look at December is rather March is normally a 0 return month, but this time we found that March was actually negative, right? So other than that, so it was slightly pushed back and delayed, but April came back with a bang, right? And made up with a higher return than the past. So so what is it, and what do we think of Indian equities as we go forward? We think that the setup will sort of continue and is likely to be improving. We have a whole lot of macro parameters. You can see that GST collections are at a peak. You're finding that liquidity is being supported by RBI and various measures. Okay, and it looks like even global risks are getting priced in. I think oil also, hopefully, we'll see the end of this war. Though I still want to keep it open, okay, which is why in some of our slides, we have not yet said that it's over. Okay, so there's a pause right now and hope it ends. Okay, but we just want to be conservative when we look at it. And the Rupee-Dollar also, I think once crude sort of stabilizes, we think that Rupee-Dollar will also sort of stabilize. The small and mid caps have sort of come back and done well and started moving up strongly. Earnings growth also have come back for them. Okay, and SIP flows continue. So some of the small cap schemes also have got opened up for fresh subscription. So broadly, one sees that there's a positive environment for the markets also to move up. However, like I mentioned earlier, I think we still believe that there could be certain volatility left, up for the next 2-3 months, and that in our view can be the best opportunity also to, if one has not allocated money to equities that could have, then that probably would be the best time to sort of look at investing. So in summary, what are the portfolio actions one should take? I think one is diversify. We are saying go across both India and global equity. Within global equity, there are certain themes that we like. We're also driven by AI in developed markets, and we also like emerging markets. They're coming up after a very long, something like some of them after 15 years downturn. Emerging markets are some of the markets are coming up. And gold as well, we believe, is likely to do well. So having a disciplined diversified strategy will sort of help. Review market cap exposure. We think you can increase mid and small cap, okay, for the reasons already mentioned, and strategically rebalance. It's important to continue to track your sectoral exposure and look at it. And so coming back on a few points, how do you position your portfolio? One spoke about India equity versus global equity. We think this is a period when you can do both. And of course, on global, you have to also be selective as to where you put your money. Okay, equities versus precious metals. We think that precious metals did very well relative to equities for a period of time. So we think equities will sort of grow faster than precious metals. However, we think that due to the certain global governments and the deficits that some of the governments are running, etc., gold will, in our view, continue to do well. And there also has been a trend that post wars, etc., you find gold also runs up and does well. Large cap versus small caps and mid caps, like I said, small and mid caps I think are likely to do better, but it's good to diversify. And large caps are actually at lower valuations, very low valuations. So from that standpoint, it makes sense to have exposure to large caps as well. Gold versus silver. We have a little bit of a preference towards gold. Silver, saw a deep correction. We need to watch when it sort of gets over, but of course, in the long term, silver is a higher risk, higher return type of investment. So, averaging through the downturn may not be a bad, way to go about it. The AI theme, is also likely to continue to do well in our view versus consumption. Yes, the AI theme will probably do well, when it's in momentum compared to consumption, but we want to be watchful and we want to be also booking profits, whenever we see spikes, because we clearly believe that, we are the AI market is maturing, and so when that happens, you'll probably find spikes, and corrections also have been sharp as we've seen recently. Okay, and so it's good to have a cautious, optimistic approach.